Welcome, everyone. I'm delighted to host a conversation today with Ruchir Sharma, chairman of Rockefeller International, a longtime colleague, advisor, and friend. A popular market commentator on TV and in print, author of best-selling books, including his latest, What Went Wrong with Capitalism. He's recently published his latest piece for the Financial Times, outlining, as he does every year, the top 10 global trends for 2026. Ruchir, it's great to have you here again.
Thanks, Greg.
This is one of the things, one of the moments that you and I look forward to the most, looking out at the beginning of a year with you, and you're almost unique in this, willing every single year to talk about the top 10 trends you see for that year, and to be willing to talk about what happened in the prior year on an interview like this with me. So why don't we start, before we get into 2026 and the predictions you've made there, go back to 2025. And let's start with one of the trends you predicted in 2025 that you pretty much nailed, that really worked out the way you expected. And then we'll get to maybe something that didn't go as well. But let's start on the positive side, since you got a lot of it right.
Well, if we look back at 2025, the overarching theme I had there, Greg, was that this would be the year that would mark the end of American exceptionalism. And what I really meant by that was that the American market had outperformed the rest of the world by a very significant margin, right up until the last year.
Over multiple years.
Over multiple years. In fact, it was a 15-year stretch punctuated by an ordeal where the rest of the world outperformed. In 2025, what we saw was that the rest of the world stock markets, in dollar terms at least, outperformed the U.S. by the widest gap since 2009.
Wow. So since before the whole 15-year run where the American markets were ahead.
Exactly. And so I think that was a very significant call, because people forget now that at the beginning of 2025, the entire investment community was obsessed with this term American exceptionalism, which is the fact that there's no other place in the world worth investing in. It's only America. And my point is, yeah, I love America. I think it's a great place to invest in. But how much of a capital would we put here? Because as we had discussed back then, that the American weight, or the American stock market's weight in the global MSCI indices, which people use, was approaching 70%. Wow. And I thought that, that was getting a bit too ridiculous.
Particularly the U.S. economy is about a quarter of the world's economy.
So like a massive disconnect.
Yeah.
So I think what we saw in 2025, which played out, was the fact that even though the American market was relatively resilient, the U.S. economy was relatively okay, the rest of the world stock market significantly outperformed the U.S. with the S&P's returns almost double the returns we got in the global stock markets, right? So that, I think, was a very significant thing which played out. We don't know exactly how it would play out, but that's what played out.
And by the way, before we get off this theme, because we talked about this last year at the time, because so many people pushed back on it, and as you said, you called it, it's a relative case that you're making.
Yeah.
You weren't down on the American economy or even on the American market. You were merely saying that the U.S. equity markets had gotten to almost 70% of world equity market capitalization, and it was too much.
Right.
And the relative had to start to correct.
Yeah.
And that was your point then, and so the American markets did do pretty well in 2025.
Yeah.
And there was a lot of resilience, and you weren't betting against that. You were just saying, relatively speaking, it has to come back into a better balance.
Yes.
Right.
Yes. I think so. That worked out okay, and that was the overarching theme of what we discussed back in 2025. Now, if I were to look back in terms of what didn't quite work out as I thought, I think it has to do with the fact that I personally thought that, just given the amount of money that is being spent on AI by these hyperscalers, as we call them, I thought that the market would begin to get much more worried about that. And we've seen some fragmentation there. In fact, if you look at the so-called Magnificent Seven companies, 5 out of the 7 have underperformed the S&P 500 this year. So
Which is actually, that's a big change, though.
Yeah, that's a big
from
change.
The prior,
Yeah, so only 2 companies have outperformed the S&P 500 by a very significant margin. Those are NVIDIA and Google.
Google, okay.
Yes, that's
so Microsoft's behind too.
Yeah. Marginally.
Okay.
Right, so that's how we ended the year. So I think that, but I thought that the underperformance would possibly be greater, because if you look at these companies, what's happening is that the price to free cash flow multiple, most people look at the price to earnings multiples. But the price to free cash flow multiples of these companies is now approaching 50, 60, 70 times. Right. Just because free cash flow growth is obviously dropping much more fast compared to their earnings growth.
Because of the capital expenditures they're making in AI.
Yeah. So which they can amortize over time. But the free cash flow growth has really slowed down of these companies. So I thought that the market would begin to penalize these companies more, and it's not. So I'd say because the optimism about AI and with the returns on AI, and that's one of the themes that we're going to discuss for 2026, I think that's been the big change.
Well, let's go. That's a perfect transition to beginning to talk about 2026. And let's go to one of these great debates that's happening out there that, as always, you're in the middle of. And you've stuck a stake in the ground saying, effectively, be careful with some of the exuberance around AI. And I want to make sure we parse this as well, because I know you believe that it is potentially a breakthrough technology at the same time.
Yes.
So when you talk about, and you use the word bubble, and you analyze bubbles, and you've got 4 O's in bubbles, which you could talk about here, what are you specifically referring to in the AI context, particularly against the backdrop of what I just said, which we can go to after, that you do believe that AI could be potentially a breakthrough technology? And your argument is you can both have a bubble and have a breakout technology. And in fact, sometimes those two things do come together at the same time. Arguably, some of that was in the internet time. So talk through first the bubble, and then the dichotomy between some of your bubble concerns and the fact that you do think AI could be a real breakout technology.
I've studied bubbles for a long period of time. In fact, it's a topic that's fascinated me. And if you look at the last 200 years, starting from
And that is, in Ruchir Sharma diligence land, it's 200 years of bubbles.
Yeah.
Yeah, all the way back to tulips almost, right?
Yeah. If you look back at the first, bubble, which had a big economic consequence, that had to do with the railroad bubbles, right? Which were, and there were two
late
of them.
19th century.
Yeah. And there were 2 of them in that century. And then what you see since then are a few consistent patterns. One, that whenever there is some major breakthrough technology, it is always accompanied by a bubble. Because in English terms, what is a bubble? A bubble is a good idea gone too far, right? So that is the pure English as far as that's concerned. Now, of late, what we've seen is there's almost a bubble and bubble talk that a lot of people are,
I would agree with that. It's everywhere.
Talking about bubble and stuff. And what I've tried to do is to come up with a framework that how do you know if something is a bubble? What is the consistent pattern that we have seen? When I study the big bubbles, and these include things like China in 2015, Japan in the late 1980s, and stuff. There are a few consistent
Internet, right? Late
patterns.
90s.
Yes, of course. That's the most obvious one.
But Japan was. Remember, Japan's, the Nikkei didn't get back to the same level.
For many decades.
Like 3 decades, right?
And there was a major disconnect there, which is that the Japanese economy was about 15% of the global economy back then. But the Japanese stock market at one point in time was nearly 50% of world stock market capitalization.
1550, yeah.
So like a massive disconnect which took place back in 1989. Now, when I look back at all these bubbles, there are a few consistent patterns that I see. So let's talk about the 4 O's, because that's the framework that I came up with. The first O has to do with overvaluation, that in any bubble, because there's so much excitement, a lot of people driven by this new era thinking are willing to pay up a lot for what they think is a very exciting future. So the valuations become very high of everything at the heart of a bubble. And one of the very simple tests, because valuation at times can be misleading, because remember in 2008, we had the housing bubble. But the stock market never got that expensive.
Yeah.
Because the earnings were okay, but the earnings were being artificially inflated by too much debt in the system. So just looking at PE multiples sometimes can be misleading, because you have to look at whether you're over earning as well, and if the earnings is being driven by too much debt. So there's a bit more deep analysis we need to do. But in very simple terms, if I look at the big bubbles of the last century or so, there's one pattern, which is that the price increase in inflation adjusted terms tends to be about 10 times over a 10 to 15 year time horizon, right? Like the price increase. Now, American tech firms, led by the Magnificent Seven, have experienced such a price increase over the last decade or so. Now, what I'm trying to do is just try to come up with some objective criteria. Right. This is what happened in the past. It doesn't have to happen again. But what's the objective criteria? So when I look at valuations, and even the stock market's overall valuations, yes, it was much more expensive in 99, 2000. But if you look at the last 100 years, we are in the top 5 percentile of the valuation that we've ever experienced on any metric that you look at, whether it's price to earnings, price to long-term earnings, price to free cash flow. we're all there in the 95th percentile to between 100th percentile as far as valuations are concerned.
And when you look at that, though, can you parse it? Because unlike 2000 and some of the companies then that were trading at 100 times revenue or whatever it was, the Magnificent Seven, while they've traded up significantly, the earnings creation still is enormous.
Yes.
And the market position is so dominant.
Yes.
You would still expect a run from here that I don't know whether it justifies the valuations, but it's a different animal than businesses that really have not become financially anywhere close to a lot of these companies. That doesn't mean there aren't companies within the AI universe that are following the tailwinds taking everybody along, but there may be parts of the market that are bubble-like and will not be justified, but then parts that are, when you look out 5 years from now, those companies were so good, even though they had traded up 10x, they really justified it.
Yeah, but the only comeback I'll have here, Greg, is the fact that if capitalism is truly working, then we will see churn as well. Because if you look at the big winners back in 2000, very few of them still exist today.
Right.
And even Microsoft and Amazon, which existed back then, went through a very long bear market before they came back.
They did.
Right? So I think the whole point is that these are great companies, but that doesn't mean that they're going to outperform every year, all in. And also, if you look at the S&P 500, just look at the amount of churn which has happened since 2000 as well.
It keeps accelerating, right? There's more and more churn. Every decade, the S&P 500 turns even faster.
It used to happen. The last decade, it's been much less. And
that's okay. So that's true. The last 10 years, the S&P 500's
become more concentrated and the churn has gone down.
Wow, that's interesting. Because you would think in a world of technology with all the pace of change, the churn would have gone even faster.
Yes,
That's not the case.
It's possible that because of a new technology, the churn may accelerate because these are companies.
Like AI could cause this.
Yeah, AI could cause this because these companies end up spending so much that it sort of hurts their profitability, and some new companies, maybe the late adopters or whatever, like in 2000, they're the real beneficiaries of that. So anyway, just like on this topic of the 4 O's, so I've tried to establish that, yes, that if you look at valuations, whether it's in terms of just raw prices or multiples, that we are pretty extended. Now, you can say that we're not as extended as 2000, but we are quite extended.
I would argue that we're not as extended into things that, with hindsight, it's always hard at the time.
Yeah.
Really, we're not going to be sustainable business models. I would argue that more of it is in like these Magnificent Seven and companies that are likely to be around in some form, longer. But I hear you. Yeah. And what you're trying to do is establish objective criteria.
Yeah.
So that first one is valuation.
Based on that, based on just prices, valuations, that's the result.
Yeah.
Then let's look at the second O, which I speak about, which is over ownership. That because there's so much excitement, everyone just wants to own the same thing. Or there's too much concentration of money which goes into a few stocks, and that happens. And here there's one data which I think gives me some real cause for concern. That if you look at just the American stock market today, 52% of the average American's wealth today is in the stock market. 52%.
In public equities.
In equities in general.
Yeah.
Most of it is public equities. Very few people have access to private
companies.
and stuff. So now the fact is that American households, equities form 52% of their entire financial wealth. That's way above the number at the peak in 2000. America today is possibly the only country in the world where there's a larger share of America's savings in the stock market than in property. That's a huge change which has happened. So there's a lot of excitement about the stock market, and people have put in lots of money into the American stock market, and you can see it in terms of the trading. The retail trading activity has been off the charts, and people are buying call options. There's massive amount of retail trading, and there are all these stories where a lot of the young generation, they have sort of said that we can't afford to buy a home, so let's punt around in the stock market. Right? So you've seen that. So that kind of frantic retail trading activity that you see, and this very heavy ownership of the market, is also something which has taken place now. So my second O, which is over ownership, also checks out. The third has to do with overinvestment. That because there's too much excitement in any sort of bubble, you end up getting lots of investment that goes through. And you've seen that in AI, the investment has been accelerating very sharply. And now tech investment, if you look at it in the economy, is at about 6% of GDP. higher than we were in 2000. I can argue that over time this should increase anyway.
Should, right? Because it's a more central part of the economy today, and will continue.
Correct.
Yeah.
But it's accelerated very sharply. And now the issue is that a lot of the techno-optimists, they're telling us that the only way that AI pays off is if we take out labor.
But wait, before we go out to that, some of that tech investment is in capital investment, which this country's behind on. You're right. I mean, like when you look at trying to enhance the energy capacity of the country, which a lot of it's going into data centers and China, for example, has invested a tremendous amount more. Now, a lot of it's government money, not private money. But isn't some of this a catch up in things that will be good long term for the country one way or another? You have a greater energy production capacity. Doesn't that last for decades and decades? And it's
great. So I think that we have to make a distinction here.
Yeah.
Now, even it happened in 2000 that the bubble ended up being pretty good for the economy. But what's a good thing for the economy and what's a good investment can be two different things.
Right.
So
the individual stocks in individual companies may be very different.
That was the big difference between the 99-2000 bubble and let's say the 2008 bubble.
Yes.
Right? That like in housing, it was a completely wasteful bubble.
Yeah.
Whereas in 2000, you got a bubble in the tech sector, but that ended up laying the groundwork for a lot of productivity increases that you saw in the subsequent years after that.
And you think this one might be more like that along my point, which is it's actually real investment going into real things, and that'll have a benefit over time.
Yeah.
Yeah.
And the fourth O I'm less concerned about, that has to do with over leverage. That if you look at the balance sheets of corporates, you look at the balance sheets of households, those are not that extended. And yes, these cash generators, Amazon, Microsoft, now they all started issuing debt, as you know.
Yeah.
But they're not. But they're at least not anywhere close to as leveraged as some of the companies were back in 2000. So that's a saving thing. The only fault line, again, I'll point out there is that this time the entire buildup of leverage has happened on the government's balance sheet. And that is something we need to keep an eye on because it comes to my final point on this topic, which is that if you look at every single bubble in history, there is no single point at which a bubble just bursts, right? That there's no point at which something gets too extended and it bursts under its own weight. There's always been one catalyst which has burst a bubble, and that's higher interest rates.
Well, let's transition to that. Yeah. Although I do want to, we'll make sure we spend some time on the federal debt, which is something you and I are completely aligned on, and having a deficit of 6%, 7% of GDP when you're close to full employment. This is the first time in history we've done that.
Yes.
Every time I say this now, I make the point that it's not a political statement, since both parties have now done it in the last 5 years.
Yes.
But let's transition to rates.
Yeah.
Because so you're saying that rates are every single time the source of the prick.
Yes.
Now the Fed is trying to balance this. The word I keep saying they're trying to avoid is stagflation.
Right.
Which is unemployment starting to go up and inflation being sticky or continuing to go up, starting to go up as well. Which, by the way, you have to be, around a long time now, like me, to remember stagflation.
Yeah.
In the early 1980s was the most extreme time, obviously. So they've started dropping rates. Really, in the last meeting of 2025, more division than I've seen in the Fed in a long time.
Yes.
Forget about politics. I think the people sitting on the Fed disagree about where we are because some are going after employment and some are going after inflation still. Where do you think we are with the Fed, now looking out in 2026? What's going to happen from here?
Well, first the facts that the Fed has missed its inflation target for more than 5 years in a row now.
That was the 2% target.
Yeah, that was the 2% target. 3% seems to have become the new normal. And I don't see the Fed, even by its own admission, getting back to a 2% rate for the next couple of years. And I think that that's a problem because this country is facing an affordability issue here. That for many people, grocery prices and other daily staples, that their prices have gone up 20, 30% or more over the last 5 years or so. And they're feeling the pinch of that. So I'm not in favor of the Fed cutting interest rates further from here. And my fear is that if the Fed tries to cut rates more from here, the long end, which is much more independent of the Fed, even though the Fed is still involved in buying some of the long-term securities, I think that that's what could end up getting unanchored. So if I were to see some threat to the economy in 2026, the leading threat, it would be that the long end gets unanchored. That inflation is still sticky.
And long end rates
and that
spike up.
The Fed is still keen to cut interest rates because it's focused on the labor market and there are other political issues bearing on it. But the long end begins to get unanchored. And sometimes you have to watch stuff happening in some other country to know as to how it can have a butterfly effect here. And one country I'm watching very closely in this regard is Japan. Because Japan's where this experiment first started, of the government building up massive amount of debt, always stimulating. And now in Japan, with sticky inflation as well they're being forced to normalize interest rates. And long-term interest rates are showing some signs of getting unanchored.
Yeah.
And so I think that if it happens there, and something bad happens there, that could have a negative knock-on effect on the US, because then the worry could shift here.
Yeah.
That, okay, what is the world's premier country with the world's reserve currency doing with its debt? So that's something I'm watching very closely.
Very fair. Question for you, though. If you're the Fed chair and employment weakens from here, what are you doing on that? I mean, let's agree maybe inflation at the same time is staying sticky.
Yeah.
And I agree with you on the 3% target, although I think part of that is that we're running these big budget deficits and they're okay. Everybody's aware of the deficits. And obviously nominal growth, if you have a 3% deficit and you can generate real growth of 3 or 4%, you can outpace even a 6% deficit. So I tend to think they'll never say this, but a little bit more inflation in the system, if you become as much of a debtor nation as we have, is a bit of a tonic. Not the right way to do it, but
Greg, there's like a real problem with that, which is that if you look at it for the average person,
no, I agree.
Affordability is the number one issue today.
I agree.
Right? So it's very difficult to sort of justify this. And in fact,
it is. I'm just saying that I think some of that's unspoken in the mix.
Yeah, but I think that
I much prefer them to actually cut the deficit and run it at a less hot rate than do it this way. But I think that's part of the reason why they might be willing to tolerate it.
It could be, but I think that this is where that the political class may get a bit more active, because one of the things is that if that we tend to look at this from a pure financial perspective, but there's a political economy also out there.
Yeah.
And the political economy, there are consequences. People win and lose elections.
Next, coming up November.
Yeah, and in 2026, the big thing is the midterm election.
Yeah.
So I think that's something which we tend to sort of, could there be a signaling mechanism there, which then forces the political class to make this the central issue?
And because I do agree with you, there is a real pinch of these higher prices for many Americans.
Yeah.
And they are feeling it. But you're the Fed chair. Unemployment ticks up. Maybe we'll come back to it. Some of it because AI is starting to create productivity, but at the cost of jobs. What would you do though?
I've written about this openly, which is that I'm not in favor of the Fed cutting interest rates at this level, because you have,
even if unemployment keeps ticking up.
Yeah, but no, as long as you're missing the inflation target by this much.
Yeah,
I think
so. You'd focus on that.
I'd focus more on that, because you've missed it for 5 years in a row, and it's really hitting the average person. And there's also one more consequence, which goes back to the point, which is that just look at the amount of financial market speculation going on. With everything going up, gold has gone up so much.
No, and you would definitely tilt on that side at this point.
That's right.
Let's go to another topic that you've written a lot about, and that frankly it was part of the core of your book on what went wrong with capitalism. Remember, you said there are 2,000 new regulations.
3,000 every year.
Every year,
yeah.
And there have been 20 taken off the books in 50 years or something. So the Trump administration's made this a centerpiece of their policy. And they're pushing hard on it here. And it seems to be creating momentum, not just in the American economy, but in other places around the world, potentially even Europe.
Yeah.
Is that fair? Are we in more of a deregulatory mode, not just in the United States, but in developed economies around the world right now, where
everywhere, absolutely. So that's one of my top.
Yes.
Yeah, that's one of my top 10 trends. That deregulation goes global.
Goes global.
Yeah,
exactly.
Which is that it's happening in the US, which I think is a very positive thing, because the amount of deregulation required here is enormous, given the amount of regulation that was put into place. But the good thing is
relentlessly over 50 years.
That a lot of the countries around the world are doing this. There is a positive signaling effect of that, and also that they realize that to compete in this environment, if America's got deregulating, we need to do a lot more as well. So in Europe, but even countries like India, Vietnam, all these countries, I'm seeing a wave of new deregulatory steps take place.
Because this is one of my themes on the United States, which is the creation of new businesses. I think there are 35 million businesses in the United States with fewer than 500 employees, and 4 to 5 million new businesses a year, and they get capital from early stage all the way through to later stage, and that's the engine of the American economy. And that really is tied to a light touch on the regulatory side in so many ways. It's an advantage. And now that the United States is pushing that harder in a world where innovation is moving so quickly, driven by AI, I think these other countries will need to do that.
So they're doing that. And in America's
they're all going
case,
to read it in your book now.
But
in your top 10 trends here.
And in America's case, as I said, that there was too much regulation going on even for America's good. So the fact that America is turning back on that, and that the rest of the world thinking that we have to compete with America, I think is accelerating their deregulatory push. I think that's a big positive for the global economy in 2026.
Excellent. I do too. Let's go to China. As always, regarding China, you've been candid and pushing the envelope. In 2025, you wrote about the idea of China being uninvestable. Now, and you and I
in 2025, in fact, I wrote that China is investable again.
For the first time, yes,
exactly.
For the first time. It.
I turned that.
But for a decade, a long time, you'd been in a different camp.
Yes, that's right. So I was very negative on China, thinking that their debt and demographics problem was something which people were underestimating, and then we saw that for the between after the pandemic, the Chinese bubble sort of pricked.
Yes,
and we saw 5 years of massive underperformance.
Right.
But in 2025, for the first time in a while, the Chinese market actually outperformed its peers, both its major emerging markets and also the US. So one of the big themes I had for 2025 was that the pessimism on China, the Chinese market in particular, was overdone, and we're likely to see a return to people investing in China.
By the way, we should have had that up front as one of the ones that you pretty much nailed. And in fact, not only did you nail the economy, but you can expound on this. They are one of the two major forces in AI now going forward. So how do you see it at this point going forward?
I'm getting a bit more concerned again, because what's happening in China is this, that there are two things which are propping up China just now. The stock market is being propped up because all the gains that I spoke about this year with the Chinese stock market, the MSCI China is up close to 30%. All those gains have been mainly concentrated in the AI plays in China. Outside of that, not much is going on in the Chinese market as well, even whether you look at price performance or you look at earnings as well.
Okay. So highly concentrated.
Very concentrated in that. But the second point, which I think is even more significant, is that the economy is now being driven all by exports. Domestic demand in China is extremely weak today. The property market is still collapsing. Investment is very weak. And so I think that the domestic weakness is almost being masked by the export engine. And the export engine is incredible. China is exporting its entire surplus abroad. And it's doing so by slashing prices.
And also the production capacity is amazing. I read somewhere that they could make 65 million cars. In one country.
But I think that, the big trend I see this year in 2026 is the fact that the pushback is going to come from many other countries. You see, in 2025, the world was very focused on fighting or negotiating with America because America was quite aggressive on tariffs.
Right.
It seems to me as if we are now past the peak drama on tariffs, that whatever had to be done, President Trump has done. If at all, we're likely to see the effective tariff rate possibly drop somewhat in 2026. So
as he does things selectively on, to try to alleviate prices in certain areas.
And then we also have the court, the Supreme Court decision coming on this, and we'll see how that plays out. But my feeling is that now the attention of the average country is going to turn much more to the damage being caused to them by China's
$1 trillion surplus.
And dumping it, and I use the word dumping very carefully here, because if you look at the prices, China's cutting prices massively on the goods that it's pushing out of its country. Now, this is having negative consequences. I was in Indonesia.
This is happening, excuse me for interrupting, at the same time that exports to the United States are down. So these other countries are absorbing tremendous amounts of Chinese.
That's right, because China's share is actually going up.
It's amazing.
So it's exports
With the biggest importer in the world going down, the share is still going up.
Still going up because they're exporting like crazy to other countries, and they're doing it by slashing prices. Now, I've traveled to some of these countries which are facing the brunt of it, say like Indonesia. Now, in these countries, what's happening is it's costing jobs because it's gutting the manufacturing sector. It's leading to a deindustrialization in these countries.
Well,
and these countries have...
Does that beyond Indonesia? Is it
Indonesia, President Macron complained about this. India, Mexico,
Vietnam?
EU, and Southeast Asia. So you have many countries which are starting to complain about this.
Yeah.
But so far they've been relatively restrained in doing something about it because they were so focused on fighting
tariffs of the
United States. But now that the pressure from that begins to ease somewhat, I think the attention is going to turn much more to this. So therefore, one of my big trends of 2026 is that the anti-dumping duties against China and other restrictions are likely to increase significantly.
Wow.
Because the world turns its attention to that problem rather than tariffs from America.
But this is almost as intractable as some of what was going on in tariffs. China's kind of stuck, right?
Yeah.
I mean, they need to export.
Yeah.
I mean, it's got to go somewhere. Otherwise, they're going to lose more jobs.
Yeah.
And they already have a slow domestic economy, as you said.
Yeah.
So how will it resolve itself?
Well, I think that in China's case, all of us have to just accept the fact that its underlying economic growth rate is not the 4 to 5%, it's closer to 2 to 3%.
Wow.
This is not an economy which either has the demographics and is already over indebted, so it doesn't have the capacity to grow at 4 to 5% or so. And this massive export surplus, which is generating about a third of Chinese growth just now, this cannot continue as well because the rest of the world is going to push back against it. So that's one of my big trends of 2026.
But that might reduce Chinese growth even further.
That's right.
Which will create issues there.
Exactly.
Well, let's go to another one of your predictions for 2026, quality stocks. I want you to talk about quality stocks. So, I think part of your premise is that some of this speculative fervor that's gone on in tech land because of AI has overshadowed quality stocks. And the way that you look at quality stocks, I think that they've been undervalued for a long time, and you think that this is their time.
Yeah.
Right.
Yeah.
So how do you define quality stocks, and why do you say 2026 is the time?
Yeah. So let's start with how do we define quality stocks, because every fund manager in the world will tell you that I love to own quality stocks.
Right. Because they'll talk about value stocks or something. Yeah.
Yeah. But I'm saying that, so, there are three main criteria that we look at defining what a quality stock is. We look at companies with, and this is how the MSCI benchmark keepers do it. One is companies which have a return on equity of above a particular level, typically about 15-20% consistently over a period of time. Then you look at the fact that their earnings tend to be relatively stable, and they also tend to have low leverage and are not that volatile. So that's the rough definition.
Sound like great businesses.
Exactly.
Yes.
Great businesses. Now, over time, these businesses tend to compound much greater at a much greater rate than, let's say, growth stocks or value stocks or other factors, right? So quality tends to do very well. About 1 in 5 companies globally meets this criteria of being labeled as a quality company.
The criteria you just let.
Yes.
15% ROE.
Yeah. Like ROE, low leverage, and relative earning stability, right? So that's what they.
Okay.
So about 20% of companies worldwide meet that criteria. Now, what happened in 2025 is that quality had one of its worst years ever. In fact, in places like emerging markets, it was the worst year ever. Because, as I said, a lot of the unprofitable companies did very well, partly because of AI and stuff. And
including in emerging markets.
Including in emerging markets. So my point is that historically, whenever quality, which generally tends to outperform over time because these are good businesses, has such a underperformance, the following year or two tend to be very strong comeback years for quality. So that's my basic point. Now, if I do a further refinement of this, and I say that let's look at, because even value as a factor hasn't done that well in places like the US, that let's look at the cheaper quality stocks around the world. Then we find that the universe becomes even more attractive. And so the projected returns that I have, that if you buy a combination of relatively inexpensive quality stocks, I think that you could generate 15% dollar return compounded over the next 3 to 5 years.
Wow.
And I'm saying that that's a pretty good deal to settle at at a time when normally when the S&P is at, these kind of valuations, the forward expected returns tend to be relatively low, just because you're starting from a higher base. So my point is that this could be a great time to buy quality stocks, particularly if you apply some sort of a value filter to it, a combination of quality or value. So that's one of my big trends. I think that quality does relatively well in 2026. It's a bit of a comeback here. And normally, whenever qualities had such a drawdown in terms of underperformance in the past, as it did in 2025, the following year or two tend to be quite strong for comeback years for quality.
So that would be that 20% of stocks would outperform then. And then, what
Yeah,
happens?
the 20% and the value cohort of the 20% in particular.
Okay, so that's a subset of the 20%.
Yeah,
and
that's
then
right.
the overall market, we'll see.
Yes.
I wanted to ask you another question, circling all the way back to AI, and we were talking about the bubble, but I know you think about it away from just near-term stock market and, in the next year or two. And one of the things you have famously said to me multiple times, talking about other things before AI, is that there's never been a breakthrough technology that's cost more jobs than it's created. Where do you think we are now as we start 2026 on this AI trajectory? It's obviously an incredibly powerful tool. You've heard me say that I think every single company, public and private in the United States and probably around the world now, is trying to figure out how do I incorporate it to enhance the efficiency of my business, to grow faster, to do more with the same workforce. Walmart in the fourth quarter of 2025, they came out and said they expected no more people over the next 3 years, but they expected to grow X%. So where are you with AI in terms of the impact on labor and on society more broadly? Will it be, the internet did cost jobs, but it also created, whole new industries. You and I talk about the search optimization engineer,
Yes.
which didn't exist, obviously, in 1995. And then you had all these people doing that. That job now looks like it's going to go away with AI. But what is going to be the net effect on employment? And is this going to be both a massive productivity bump for all the United States and all economies, and something good for, the workforce?
Yeah. So I think, I have 2 points here, which is that to the extent that AI makes the average person more productive, it's terrific because we all want to become more productive. The problem I have here is that if you hear the techno-optimist talk, they say that that AI is going to work because it's going to achieve human-level intelligence and it's going to be able to replace jobs. And so therefore, the current investment is justified. I feel very bullish on the ability of AI to improve productivity of existing people. I think that's there. But the difference with this technological innovation compared to anything else we've seen in the past is that the amount of investment being done, a lot of it is being done on the premise that it can replace human beings.
But wouldn't that be true, just to provide counter on this, wouldn't that have been true when you were starting to really build out the internet? Maybe people perceived it differently, but that was going to automate a whole bunch of things. And the productivity burst that comes from the creation of the internet, like the productivity burst that could come from AI here, then creates things that even you and I say you and I, anybody, really can't envision yet. Just like the search optimization engineer, that really was your theme, which I never forgot. There's been no breakthrough technology that's ultimately cost. I'm not talking about the journey between here and there.
That every technological revolution kills professions, not jobs.
That is your theme.
Yeah. That's been like a line I've used for a long period of time.
So are you standing by that line vis-a-vis AI?
No, I think that I have a slight difference with this because I don't know enough about the technology. Mm-hmm. I'm a macro thinker at the end of the day. I don't know about the technology, which is the fact that I love using ChatGPT every day and stuff like that. That's different. All I'm trying to say is that if the techno-optimists are telling us that they are keen to create human-level intelligence, which is going to replace labor, and that they are doing this because it's going to increase corporate profit margins, and that labor is going to further lose its bargaining power, I think that creates a fertile ground for a populist backlash.
100%.
That's my point.
I just take issue. I don't necessarily agree with that vision.
Yeah.
So when I look at the company that I lead, that you're part of, I look at the fact that the AI tools could make us much more efficient. We could grow faster and better and more efficiently, but continuing to hire people because we're growing that much faster. And then the company is bigger, more profitable. But as I said, instead of 1,700 people, you might have 2,500 people. And if that was replicated across 4,000 public companies and 5,000 private companies in the United States, their vision wouldn't be correct. I mean, they're out there saying this is the vision, but they don't have. Nobody knows how this is going to play out. So I do think there's an alternative that could be more positive.
Which is the fact that like to summarize what we're talking about. How do you invest in this environment? All I'm trying to say is when I look at my top 10 trends of 2026, that don't put all your eggs in that AI basket.
I hear you.
Which is that this is, that this is by definition speculative because we don't know how this is going to exactly play out.
Yeah.
So therefore, these other strategies, which is that buy some quality stocks in your portfolio, which creates like a bulwark in your portfolio against this AI volatility and whatever speculative stuff is going on. Keep doing stuff more internationally because Americans still have very little capital invested internationally, and usually when these trends start, they tend to last. Very rarely do we see these just be one-off because here the dollar is also moving and the Fed still wants to cut interest rates. I think that that could go on, and then also in terms of, as I said, that there are other trends that I speak about, which is that look for places which are deregulating. Those could be the places where you want to put much more capital internationally. So I think that that's the basic point that I'm trying to make here.
This is a great place for us to end because you just hit some of the great highlights. Quality stocks, invest internationally, look for internationally the places that are adopting the U.S. perspective on deregulation.
Yes.
There's some things that are important parts of a portfolio as we start this new year.
And sure, has some stuff that you want exposure to AI and stuff here, but remember the fact that we don't know how this plays out. And so you need to hedge your bets at the very least by diversifying.
Very smart. And by the way, we don't know because nobody knows.
Yes.
Which is why the techno-optimist vision, I'm not signing up to. And I think it may not be what plays out here.
Yeah.
When we're looking back at this 5 or 10 years from now. Ruchir, it's always fantastic to have you here. The willingness to wade in to things that are real time because you don't know what's going to happen and say, this is what I think is going to happen. And some of the courageous calls, like where you said this time last year, American exceptionalism, yes, it's a great economy, but it's gone too far on the relative market cap of the U.S. economy to the rest of the world, and therefore the rest of the world will outperform. And then having that prediction be correct as it was, and you saying in 2025, China's, I'm less bearish on China. This is a year to invest. Bravo. So, some of these things are going to be things that we look back at the end of 2026 where people say, yes, again, once again, Ruchir Sharma has nailed some things that were out of the box. Thank you for being here and sharing your predictions for 2026. It's an event that you and I both look forward to. And this year was, as always, interesting and full of tremendous insights. I'd like to share a quote as we close this year's predictions. This is John F. Kennedy, who said, quote, "Change is the law of life, and those who look only to the past or present are certain to miss the future." I picked this in honor of Ruchir because he's constantly pushing the envelope and trying to look out ahead of most people. And thank you, everyone, for tuning in. I hope you enjoyed my discussion with Ruchir Sharma.